look at the broad market and what it's given you, go with the flow of what's happening, look at what sectors are leading that, driving some of that. And then when you're looking at the stocks, what's the best ones to go with that within that particular group that's the leading factors here. And when you look at things like Tesla, number one, Tesla just, they had a pretty good year. They were a couple cars short of their 500,000 car delivery in a year.
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Ewell. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we have a special guest. We actually have two of the founders of MarketGear.com. We have Rance Mascheck and Chris Mercer. Now, we've had Rance on in the past talking about Market Gear, and actually, this is a special episode sponsored by Market Gear. We want to send you guys over to MarketGear.com/Chris Ewell. That's spelled ChrisUhl. That's me. But I want you guys to go check it out. There, you will have a 2-week free trial plus 50% off your first month of Market Gear. And it's a special deal just for listeners of this episode. So, guys, thanks so much for coming on and offering that really cool discount to the listeners to get started.
Glad to be able to do it, Chris. Enjoyed our last session with you and look forward to today's as well.
Yeah, this is really cool. So to give the audience some background, after our call with Rance, I was like, you know what, Rance, I really clicked with you. It's not everybody that I get to click with like this, so I really appreciate your time. And Rance has a huge history of being inside the market, being a real wheeler and dealer himself. And the fact that we can have him on the show, not just once, but twice, and maybe a few more after this as well, I think it's going to be really, really useful for the audience. So thank you for your time.
No problem. Glad to be able to do it.
So guys, I'm ready to get started about this. We're going to be talking about bull call spreads today. Now, typically, whenever I talk about them, I would call that a call debit spread. So if you hear me say one word over the other, that's synonymous of the same thing here. But yeah, I'm excited to learn more about it because personally, I trade mainly long stock and selling put spreads. So, in my opinion, I think a call spread's similar to that, right? A bull call spread, right?
Well, it's actually, since you bring up the selling a put spread, and actually we've talked about maybe doing a session on this too, given some of our insight to it in the future. But one of the big differences is that they're both bullish outlooks, but there's a tendency for a call, what I would call a bull put spread, or selling a put spread, would be a shorter term trade where you're going to do it out of the money, and basically, as long as the stock doesn't drop, you're able to capture the premium you brought in. And if it does drop, because you're in a spread, you have a limited risk versus like selling a naked put where you could really get hosed as the stock goes down. But in a bull call spread, or in a call debit spread, the tendency to use that is a little bit more out of the money where you expect the stock to go up. And what we're going to talk about today is that approach. And when we talk about the put spread, the credit put spread in a future session, we'll do that shorter term. This one's going to be riding the trend, right? So if I have a stock that's in a trending mode here, and I want to be able to continue to profit on that as it goes up, we can put on a call spread in a way that will allow us to ride that trend and be able to generate a fairly decent return in a relatively low movement of the stock. So you can actually apply these identical. You could apply a bull call spread and a bull put spread the exact same way, both of them below the current stock price, and be able to make money on it that way. But in this case, what we're going to talk about is riding the trend, where I'm going to be actually doing it a little bit above the stock price, expecting it to continue to ride up and be able to make a really strong return in a relatively small movement of the stock.
Right. Okay. I understand now. So we're talking out of the money call debit spreads, bull call spreads versus an in the money, because if you were to do an in the money call spread like this, it would be essentially the exact same risk profile as selling a put spread
It is identical. The difference is that in the put spread, at the end, it expires worthless and you keep the cash. In
Mm-hmm.
a call spread, in the end, you're going to go through an exercise and assignment. So there's going to be an exit cost, although not near as much as of a factor as it used to be, since commissions have gone to, virtually zero, maybe a little bit of a cost for the contract cost, but the ticket cost is now zero with most brokers. So there is a cost to get out of the bull call spread versus the bull put spread. But if you were to overlay the two different trades in a risk profile, they would exactly look the same.
Okay. So I got to tell you, this could be interesting because this is almost exactly what lit the fire to start the podcast. And I say that because I'm really glad you brought this topic up, because I was watching CNBC's options action, and one of the hosts on there, this was years ago, he was saying how he thinks Tesla's going up, so you should buy out of the money call spreads for it. And it was like crazy out of the money, like a 20 delta, something crazy like that. And he's like, it's like $6 for the spread. And I'm like, oh my gosh, like I couldn't imagine a worse trade. You're telling me it has a 20% probability of profit. I'm spending $600 per contract to get into this for like an 80% chance of losing all of my $600. This is some shit, I gotta tell you. And so I sent him a Twitter message nicely, which Twitter can be a pretty ugly place. But I was like, listen, I don't like your trade. I think it's bunk. I mean, if you're going to do this, why not just sell an out of the money put spread? And he's like, well, you can make so much more with this call spread. And I'm like, yeah, but you're playing the lottery here, bro, because it's like 80% chance of it not happening. And so he came back with all of this, he tried to what was the word? All these big words, and tried to sound really smart and everything. But at the end of the day, I was like, we have the same market opinion, being that we're both bullish Tesla, but I feel that my way is a much more conservative, easier play, and a lot easier for people to wrap their risk around than an out of the money bull call spread. Mm-hmm. So I am very interested to hear this. Like I say, this was the light that started the fire.
Interesting. So I'm going to tell you that one of the big differences as we set this up, let's just, when you're doing a put spread, an out of the money put spread. So just for the listeners here, because we're going to be talking about an out of the money put spread and an out of the money call spread. Well, what we're talking about is an out of the money put spread is below the current stock price, right? And so as long as the stock doesn't go down more than whatever your upper strike is in your put spread, you're keeping all of the credit that you take in. In the case of a in the money bull call spread, that's the exact same profile we're talking about, right? So both of them would, so if I'm in the 80-90 with the stock at 100, right? Or something, is just a quick example. I'm below the current stock price. In the call side, that's an in the money spread, but they're the exact same profile. So let me ask you something here, Chris. When you go to do something like this, when you're doing a put spread, what type of return are you usually looking for?
Now, for me, I'm good with the 20, 25, sometimes 30% return on that. And when I say those numbers, when you're not an options trader like you and I I say 20, 30% return, they're like, no possible way, no way. And I'm like, dude, I do it week after week. Like, it's not that hard.
What we're going to talk about today is riding the trend and being able to generate 100% return, 120% return. Right, we're talking about a higher return, but you had a really good point. I want to be really clear here as we're doing this, because it's an important point when people are setting up trades. What you're talking about doing with the put spread is a higher probability trade. So one of the things we're talking about here is riding the trend, right? So if I don't have a trend, if I don't have a reason to think this is going to keep going up, I don't want to do the trade I'm going to talk about today, right? What you're talking about is just don't go down. Right. Yeah. If it continues to go up, you make money. If it just flatlines, you still make money. As long as it doesn't go down, you're going to make money in your trade. Wherein what we're talking about is it does need to go up. All right. So from a probability standpoint, absolutely, this is not as high of a probability trade. But if you look at your probability over your risk reward ratio, where I can make 125% return, and be able to do that on a relatively small movement of the stock, then, I don't have the same probability you have, but my returns are going to be greater. And it's why it's really important that you use your technical analysis, whatever else you're doing to make sure that you have the right opinion of the stock, and that there is a strong chance it's going to continue to move higher, because you're going to need the upward movement to be able to have this trade profit. So there's a definite difference between those two approaches. And while one increases the probability, one increases return. So there's a balance there. And it does have, so if you took the Tesla trade, the Tesla trade, I don't know the time frame of what you're talking about.
Listen, if you buy Tesla anytime, it goes up after that. That's from what technical analysis I've learned on Tesla is you buy it today, it goes up tomorrow. Like Bitcoin, it only goes up.
There was $38 billion that was lost by shorts last year on Tesla. That's anyway. But so in this particular case, we definitely, I want to be really clear here. This is a higher, well, it's actually, if from a risk reward ratio standpoint, it's a lower risk to reward ratio. Where if you're talking about making a 25-30% return, something like that, you're talking about okay, so if I have a $10 spread and I can make $3, I have $7 at risk. So if it does turn against me and you don't do anything, you're going to take a pretty good hit, right? And where this one here, you're going to have a lower risk reward or lower risk to the reward possibility in the trade, and with that also a lower probability, but much higher gains. So so we'll see as we get into it. I'm going to give you an example.
So let's get into it, right? Because let's do a little high level, and maybe this will be in your slides too. But imagine the stock price is at 100. Selling put spreads out of the money would be down at like 95, 90, something like that. And then call spreads out of the money would be somewhere like 105, 110. So just to give the audience some perspective here.
Right. Now, are we seeing my screen now? Are we seeing
Yes, looks good. I can see
we are. And can I just add too? So we're going to he's going to walk you through the spread concept in general with some, just basics of what it is and some preset an example from the past, but then we will get into some live examples from today's markets in the platform as well. So
look to it.
All right. So what we're going to share with you now, and by the way, as you're sharing that, since we are going to be getting into live examples here, just one thing very clear, anything I do today is an educational example. It is in no way to be construed as a recommendation for any trade or position in the financial markets. So we just need to, I know you disclaim this in the podcast, just want to make sure we have that here as well. And I thought a good start point here would be just as a super fast review of the call option, and because that's what we're going to be using here are calls. So if you were to go out and buy a call option, you have the right to be able to buy the stock at the strike price that you bought this at. So in my example here, I'm using Netflix, and I'm building on this. So I want to stay with my example here on this. So if we had the 425 strike, so I'm buying the right to buy the stock at 425 between now and an expiration date, a point in time in the future. When I do that, I'm going to pay a premium for that piece. Now, if the stock moves enough to make up more than the premium I paid, I'm going to be profitable. So for example, at expiration, a 425 call option is going to be worth the cash value of that. So for example, if the stock were to go up to 450, so it's 425. So if it goes up to 450 on expiration day, you have the right to buy it at 425. The stock's at 450. Your option's going to be worth $25. Now that's on expiration. But when we got into this, with it down here at it was actually at 425.50 in this example, we actually paid $39, or well, we did the call option, the spread, but the call option was at $39. So let's just take a look at this real quick of what this means. That means that if I buy this $425 strike call option, and I pay $39.15 for that option, it has to move up $39.15 by expiration, to be able to be at break even. So it would have to go from 425 to 464 to be able, we're going to knock the pennies off just for time here. So from 425 to 464 to make up the $39 cost that I put into this trade. The thing is, we're not in this to break even. We're in it to make money. So let's just take a look at that. Where would the stock have to go if I have the right to buy it at 425 and I paid $39 for this? Where's the stock going to have to go for me to be able to double my money? What has to move? $39 to break even and another $39 for me to be able to double my money. Now, I'm just using that as a reference point, but just for you to be able to see that's a $78 move of the stock to be able to double my money in the option by expiration, right? So I just want people to see that in this risk graph, we use this a lot in options trading in general, and it's basically, if you haven't seen this before, this is the price of the stock on your x-axis, and your y-axis is your profitability. So if the stock goes up, I go into profit. If stock goes down, I go into a loss. Now, the most I can lose in this, I'm doing a $425 stock. The most I can lose in this, though, is the $39, but it's still $39, right, at a 425 stock. So that's the basic of call option. So I just want us to get that at 425, it has to go to 503 or double the cost of the trade, a $78 move to be able to double my money in the trade. And again, a $39 move to be able to break even by expiration. So that's kind of the call option side. Now, if what are the challenges with just buying the call option, right? So part of the problem with buying a call option is the cost of the trade. The other thing, and by the way, now, Chris, let me just ask you something. When you're talking to people out there about options, I found this to be a case. I'm just curious if you have as well. What a lot of times people will end up doing is buying a much shorter term option because it's cheaper. Right. And so then they go through this thing where, wait a minute, the stock moved up, but they didn't make any money because the closer they are to expiration, the faster the time decay out of this, right? So this time decay factor comes into play. And so you have that. So have you seen that happen for people where they get, it does.
Let me tell you, that's the first time I blew up my account was doing that. I was like, hey, the market always goes up, so I'm going to buy a boatload of calls. Rance, I had blown up 2/3 of my account in the first 60 days I started trading.
Ouch.
And that's exactly how I did it. I bought really short term out of the money options, thinking that I knew like this was totally going to work, which, I am a huge options trader. That's kind of my thing. But if you don't know options and you're trying to get into it, you really should step lightly into it and certainly not just like put your entire account into one trade like that.
Right. Absolutely. And I'll tell you, for me, I did one of these out of the money call options on my one of my first trades, and I did well on it. It was like,
oh, great.
It wasn't,
just rub it in.
Through the roof. Well, no, but it was actually bad because what happened was, oh, this is easy. So then you start doing a bunch of them and then got totally hosed, right? So beginner's luck gave me a false sense of confidence, and I still didn't know what I was doing, and I got hosed too. So, a few $1,000s in the School of Hard Knocks, decided to learn what I was really supposed to do here. And, there are two big factors in dealing with options. There's more than two, but two big factors is time decay and changes in implied volatility. And so the more time you have in the trade, the more it's going to cost, but that doesn't mean that it's not the right thing to do to give yourself time to be right because of how time decay works. And we're going to talk about that a little bit as we go through this, but the challenge is if I just buy the call option is, number one, there's a higher cost of the trade because I'm buying the option. I'm not offsetting my cost. You'll see what I mean by offsetting cost. Your listeners will know what I mean by that in just a second. And you have the time decay factor because you're buying this option. In this particular case, by the way, I'll tell you, this was in June. We went out and bought September, so we bought several months. So we had enough time to be right. But the thing about the time decay is that the longer term you have in the option, actually the slower the time decay cost. The fastest time decay is going to be in really short term options. In fact, now we have weeklies and it's super fast in those, and there's things you can do with it to be able to profit from that. But you want to be careful because it's not buying them, right? So that's that's a challenge. Now, here's the other thing. Because you've put all this cost in this trade, you have to have a high anticipation move because of that high premium you paid. So, these are all some of the challenges with just buying a call option. And you needed to move more than the premium you've paid in. And you need enough time for it to be right. So you have to put the cost, you have to pay for that time to have a chance to have it work well. And again, as we just talked about, if you don't put enough time into it, you get hosed because the time decay hurts a lot. So some of the challenges with just buying a call, I want to talk about doing the spread next, but it's to have a stock have to go up 78, a $400 stock go up $78 is a pretty strong move in order to be able to have you really make money in the trade, or make a decent money, in this case, 100% in the trade.
Mm-hmm.
But what I want to share is, what does that look like on the stock? Just real quick. Here's Netflix at the time, and at June 15 when we got in, when we did this trade, it was at about 425. And just so you can see this in a relationship with what the trend is and what has to happen in order for this to work out, my break-even point in the trade is all the way up at that 446. And again, my 100% return. I love the fact that my mouse is a little touchy here. Whoops. That 100% return is all the way up here at 503. So if you looked at the overall trend, is that plausible? Yeah.
Sure.
But but I'd rather put the odds a little bit more in my favor. Right?
Well, absolutely. That's what I'm all about, is putting the odds in my favor. And when I first started trading, and for the first few years I was trading, the concept of trading with the trend really didn't register in my mind. It's like, oh, if a stock's going up, I'm gonna be contrarian and say that it's gonna go down, right? I remember specifically there was one day, one of my worst trades, just conceptually,
Mm-hmm.
wasn't a huge dollar loss, but conceptually, I was at the public library with my son. I pulled up my phone, all of us junky traders do,
Yep.
and I saw the Qs were up that day, and I'm like, well, I got to sell some calls on this, right? And so by the time I left, I was short plenty deltas of Qs, and it never, ever showed a profit, ever, at any point. Because at that moment, it only went up after that. And, thinking back, I'm like, I don't understand why I wanted to, the concept of fighting a trend was in my mind. I wanted to be that guy who called tops and called bottoms. I never could do it, but I spent a lot of money figuring out that I couldn't do it. So following a trend like this, it just makes life a lot easier.
I'll tell you that I've tried in my earlier days, I was pretty good at picking the tops because that's when I went in. And then it went down, right? It's like I've had a few of those. But what I found is look at the broad, this is in a kind of a macro view. Look at the broad market and what it's given you. Go with the flow of what's happening. Look at what sectors are leading that, driving some of that. And then when you're looking at the stocks, what's the best ones to go with that within that particular group that's the leading factors here. And when you look at things like Tesla, number one, Tesla just they had a pretty good year. They were a couple cars short of their 500,000 car delivery in a year. And on top of that, they've been added to the S&P 500, which of course is also a benefit. And I'm fairly heavy in Tesla, by the way. I besides owning one, I also own the stock.
I'm gonna stop you there because I am in the market for a car. And I have been wanting a Range Rover my entire life, and now I can afford one. And then there's the Model Y, and I'm like, I would love to experience 3-second 0 to 60 on a daily basis. So you got to tell me, as the Tesla owner, how do you love it?
I would tell you that first of all, it's a Model X. Which has
big
with the,
SUV,
with the doors, right? The Falcon doors. So this is I've never been a big car fan. I'm not I need a muscle car. I need this, but I love this car. And it's because, number one, first of all, I come out on certain mornings, get in the car, and all of a sudden there's all these new features because of the over-the-air updates.
Oh,
right?
That's cool.
And so when I bought the car, the autopilot was, that was a loose term used there. It would stay within the lines of a freeway. That's about it, right? Now, it recognizes stop. If you're coming up to a stoplight, it'll stop for you. And when it's time to go, it'll chime. You still have to touch the gas, so you know, right? And then you have to keep your hands on the wheel or available to the wheel and all that. But what it's done now, from going from, I live in the San Francisco Bay Area, and I go up to see my in-laws up in Sacramento. From on-ramp to off-ramp, you don't have to touch the steering wheel. 3 different exchanges, all that stuff handles the whole thing. Notices you're in a slow lane, gets in a fast one. And these are updates that have been happening over time, and they just update in the car, and now you got a new experience. The only negative at all is getting used to you have to know where chargers are and do that. Now they've made it a lot easier. There's not only the superchargers, there's all sorts of other chargers available besides Tesla's network of chargers. But so you don't have that range anxiety like you used to. Occasionally we're still, you're still a little bit of that. So you have to go looking up where one is, but because they're not as readily available as gas stations, but overall it works pretty well. It's not a problem. And I just love the car. The acceleration is awesome. It's so quiet. It's the customer service that they have is a whole different level than any car ownership I've had.
All right.
I had a tire problem the other day, needed it replaced. And I go onto the app, tell them I want it. They come out, replace the tire, and go. The only thing I had to do was open the garage door. And so the mobile service is great for that. It's a different level. They've redefined the experience through a lot of the parts. So I'm a big fan of it. I'll tell you that the X, for the price difference from the X to the Y, because I've looked at the Y, if I was buying one today, I'd be buying a Y.
It's like $100,000 price difference or something crazy like that.
It's a big difference. And do you need the car doors to open automatically when you approach the car? Is that a must, really?
I think I can live without that.
It's like, I like it, but is it worth that price difference, right? So I think the Y is awesome. We've also pre-ordered the Cybertruck.
Nice.
So the choice of post-apocalyptic world, the bulletproof glass and has power supply in it and all that. So it's been a phenomenal experience. So I'm a big Tesla fan.
Well, see, like I'm sorry I totally derailed the conversation, but
right.
This is the kind of stuff that's on my mind here. So we live in Texas. And I'm surprised you haven't moved here yet because everybody's leaving California, moving to Texas. But like the gigafactories here, like one of the Tesla like big service centers is right down the road from us. Like everywhere are Teslas. All my neighbors got them and everything. And I mean, it's not like I want to keep up with the Joneses. I, honest to God, want to have a 0 to 60 under 3-second car. Like I think that would be really fun. Like that's my number one thing over anything else on the Tesla.
Go test one with Plaid. So they used to have Ludicrous. That was their top. Now they've got Plaid, which is the super fast acceleration, it's you go test drive one that has that, and you need a headrest. I mean, it's the first car I've had that you really need a headrest because your head's going to go like that. I highly recommend.
Plaid was a thing. I got to check that out.
It's a little homage to Hitchhiker's Guide to the Galaxy.
I love that.
Anyway. All right, so keeping moving forward here because we want to watch our time here. Let's. But yeah, I'm a Tesla fan. I've been a big fan. I wasn't sure how well I was going to like it. It has been a totally different experience. In the other car I have, by the way, the other car I had at the time was a Chrysler 300, and you want to update the map, and it's kind of a big deal. And this, it's just over-the-air updates, right? So pretty cool little setup for all that. So anyway, so with that, let me, am I back on screen share here? Do we have that going right?
Yeah.
All right. So let me go back to this area. So we were talking about this call option and what it would how much it would have to move, in our case here, $78 to be able to double our money in a 425 stock. And so then what we wanted to do here is look at, some the benefits of a bull call spread and then the structure of this. So first of all, this is going to be a lot lower cost than going out and just buying the call option. And in this particular instance, it's going to be like a quarter of the cost. That quarter of the cost is also going to reduce your risk from buying the call option by about 75%. And in doing so, that means that the amount of movement to break even is a lot less, which gives you a higher probability of profit. And then two really big important points here. I said two of the biggest challenges with trading options is time and volatility. Because what I'm going to do is I'm going to buy one option and then I'm going to sell another option. I'm both buying and selling time. So I don't completely eliminate because of my position, but I reduce the cost of time in the trade and the impact of time in the trade. And the same thing with volatility, because I'm both buying volatility and selling volatility. I've now reduced the cost of volatility and, by the way, the impact of volatility, changes in volatility on the trade. So you're able to play closer to the trend. So this idea of if the stock goes up and my call option didn't, it's usually because of either drops in implied volatility or because of time decay. Because I've now, I won't say leveled it, I've reduced the impact of those two. Now I'm able to play truer to the trend of the stock than I would if I was just buying the option itself for that shorter term move up, right? So it's, that's a nice part of it. And the other thing about this is bull call spreads are repairable. I actually know 11 different ways to fix this trade or adjust this trade. So it's a pretty flexible. When you're in this trade, there's things that you can do if stuff starts to move against you. If you want to flip it from bullish to bearish, or you've just had a pullback and now you think it's going to go up again after that pullback, well, you can take your entire trade and move it down so that now as it goes back up, you're going to be at a break-even point and a profit point and a lot quicker. So there's a lot of things you can do to manage the trade more effectively than you can with a single call option, or than you can with a stock by itself. So I'm talking about these benefits. I do want to be clear. There is a disadvantage. There's a limited profit. So if you were to go out and buy Netflix at 425, the option at 425, and it goes to 800, you're going to have a cap on how much you can make. Right. So there's that. If you don't manage it, because the other thing is, if it goes up, you can always close out the trade early, go put it on again at a higher strike. So there's things you can do with it. So let's think of what that does. What I did here was we took the 425 option we were just talking about that we were buying at $39. We then went out. So we bought that 39, and then we went out to the 445. So $20 further out of the money. So we're basically almost buying an at the money option. In fact, it's slightly 50 cents in the money on that 425. But then we went out $20 and we sold the 445 option. And that one was $29. So we spent $39.15. We brought in $29.88. So instead of being in the trade now for $39, I'm in it for literally about a quarter of that at $9.28. So now I'm in it for a lot less money. So let's take a look at what that means for us. What's that going to do, and how does that play out in the trade? So the bull call spread is going to look like, if we saw this before, we saw our call option. Well, now because I've sold another one, it's going to cap out at that top strike at that 445. So I can only make money between the 425 and the 445. Once it hits 445, I'm going to cap out in my position if I don't do anything with the trade, right? If I don't close it out early or anything like that. So, but what it does do here is, by reducing my cost now to $9.28 instead of $39, that 425 call option, which by the way was already 50 cents on the money. Remember, it was at 425.50 was the stock price. What happens then is I only need to break even. And we'll talk expiration numbers, and I'll come back and talk about in time. At expiration numbers, though, I only need an $8.78 move, less than a $9 move to break even, where before we had to have a $39 move to break even, right? And why? Because I've reduced my cost to trade. You still have to move it by your cost plus the lower strike. Now, it was already 50 cents in the money, so that makes it that 878. And then the 100% return mark is also greatly reduced. So instead of 503, now I'm at which was what, a $78 move. Now I'm only at an $18 move, $18.55, because I have my 928 in the trade. So I have to make that twice. Right? So I have that, and that puts me at 443 instead of 503. right? So I'm able to make money a lot quicker in the trade with a lot less movement in the trade. So if I were to look at this on the chart here, we see now, by the way, we saw this before. We said, hey, that long-term trend, it was still plausible that could have worked with the call option, right? We were looking at that. Well, what do you think the odds of this one working are? Where all I have to, a lot better, right? In this particular case, the day we entered, just a couple of days before it was up in that range, right? So now we only have to have it go from 425 to 434 to break even, and then 443 to double my money in the trade. And so that relatively small amount of movement is because I was able to reduce the cost to trade by selling the other one. Now, selling that higher strike does cap me out on the trade, but it doesn't mean you can't exit the trade early, right? In fact, if we were to look at this real quick here, let me just show you. We talk about this here, and we're going through some different numbers. I wanted to put together something that was really easy for people to see. And if you look at this, I compared the stock to the option to the bull call. So if I go out and I bought Netflix at 425.50, what's my risk of the trade? Well, technically 425.50, although I realize that, it's probably not going to go to zero. Because companies don't do that.
Often.
Often, right? Don't do that often, right?
Hey, I don't know. I heard that if you fake an electric truck rolling down a hill, that maybe the stock price may go to zero. I don't know. It's just speculation. I've just heard it once or twice.
Look at how great our batteries are at driving this thing, and you don't see it's on the cameras are all tilted slightly so it doesn't look like it's a hill, right? I'm just kidding, but I know what you're talking, right? It definitely can happen. And I was going to rattle off a couple back when I started this thing at e-toys and these things that were. I'm drawing a blank on the name. I used to have rattle off a list of them, but the reality is, it's probably not the odds of it going there or you holding it to there, be foolish to hold it that long if it does sort of go down. But I want to be clear though, your break-even point isn't 425. It's where you bought the stock. So to move how much movement do you need to break even? Nothing. But since we were talking about doubling your money for a second here, where would that be? Well, that would be at 851. Right? $851. If you bought the stock, to double your money in the stock would be $851 or $425.50 move, equivalent to what you put in, to be able to do that. So it's 100% move in the stock. Mm-hmm. Now, I realize that you might make me going for the 100% gain, but I'm just trying to put a percentage return kind of equated here a little bit. If I went over to the option, we already talked about the $39, right? So where's my break even? It's the stock price plus the strike price plus the 39, which puts us all the way up to 464. So that's an 8% move just to break even.
Right.
On the option where, but since we're not talking about just breaking even, we want to make money. That 100% return mark we were talking about earlier was that 503 mark, right? That $503, that $78 move or an 18% move of the stock to be able to double your money in the trade. Now, while you can double your money a lot quicker, you still have that part of, I still needed to move to be able to even break even. Now we go over to the bull call spread we just looked at and what we did by by buying that same one, that 425, and then selling the 445, we were able to reduce the price of the trade and our cost and risk of the trade down to $9.28. Where's my break even? It's at a 2% move, just over a 2% move to 434. Where does it have to go to double my money in the trade? It needs to go up to 443 or $18 on a $425 stock is a 4.25% move to double my money in the bull call spread. Right. So when you look at this one, you say, okay, yeah, you can have the stock and there's benefits owning the stock. I have a lot of stock in my portfolio as well. But if I'm trying to really ride a trend, ride a movement going on here, I'm going to tend to lean a lot more toward the bull call spread because of the reduced cost of the trade, the reduced risk because of that reduced cost in the trade, and the much smaller movement in order to be able to double my money in the trade or make money in the trade. So how did this one turn out? Well, actually, before I show that, one other piece real quick. This is the risk graph. Now, we talked about that risk graph to the my profit and loss. We're showing here, this is the call. The red one here is the call risk graph, and the blue one is the bull call spread. And we did it based on like percentile, right? Just so you can see. So it was make same risk percentile in them. Basically, I'm going to make the same money in the bull call spread at 445. Now, mind you, stock's at 4.25. I'm going to make the same money when the stock goes to 445 as somebody that buys the call option would make if it went up to 497. So a much, much smaller move of the stock to be able to generate a really strong return in that. And so when you see this on the chart, when you put those two together, you can see here a much smaller move, the green ones here for the bull call spread, to be able both to break even and to make 100% return. 100% return is not even new prices for Netflix.
Right, yeah.
Where the break even was a new high, right? Let alone the 100% return mark if I just bought the option by itself. So a much, much smaller move of the stock. Now, to your point, we started out, which I thought was a great precursor to this. Mind you, I am out of the money, right? So I have to have it move up. So what are my probability of that compared to if it was down, below the current price of the stock? It's not going to be as high of a probability of profit, but look at what Netflix is doing. And by the way, just as a little add-on to this, this was after we got into COVID, right? So if you look back here on this chart, this was COVID, the February thing. And then very quickly, this was back up in the new territory because obviously Netflix would benefit from people staying at home, right? And so we're using, again, why am I getting into something? I want to see a driving force that's going to continue to push this forward, whether it's continued improved earnings, whether it's things like Tesla being added to the S&P 500, hitting their numbers on the deliverable of cars, whatever it is, that there is a driving force to move it forward. So I have, because if you just take that probability cone by itself, your standard deviations by it, I understand there's a probability factor here. But if if it's skewed a little bit to the positive because of what's going on in the broad market, what's going on with that specific stock, then your increases your odds of making it work for you.
But I think that you brought up a good point with it, though, is that this, even though it has the lower probability of profit, has a much higher return on capital percentage than you could ever get with selling put spreads.
Correct.
Yeah. So that makes a lot of sense to me.
And it's because you're a little bit out of that money, and that's why that works. So if I did it below the stock price, I'd have a very similar profile that you do to your put spread, right? Where you're going to have that 25%, 30%. You're not going to get over 100% return ever when your spread's below the current stock price. And so we are going a little bit above to be able to make that happen. So what happened with this? Well, what happened here, this is, by the way, a screenshot out of our journal, and I'm going to go into the platform and show you a couple live examples in just a second here. But this is out of our journal, so you can see the specifics of the numbers if you want to over here. But basically, here's what happened. At 6:15, we got in the trade. I did this as a one lot in my example for $925. That is $9.28 a share. So for $928 per contract or per lot, because we're doing buying one and selling one, we're in the trade. Now, mind you, what did we do here? We did the September 18th expiration date. But the thing about options is you don't have to hold them to expiration. Less than a month later, 25 days later in the trade on July 10th, the trade was worth $17.20, which is a $722 profit on my 928, or an 85% return. Now, when I talked about this, we could get over 100% return if I continue to hold it out and did that. I'm getting out early because it went up, it made some money. I'm going to show you some things on the risk curve in a minute about why also. But now we got a $792 profit, 25 days in the trade, 85% return in 25 days is not too shabby.
No, not at all.
Right. So that's a little bit about how that played out. Now, let me go back here I'm going to go to the platform here for a moment and just show you a couple things. So and
real quick, before you get too deep into that, just a reminder to the audience to go to marketgear.com/Chris Uhl. That's CHRISUHL to get your 2 weeks of free access to it and 50% off your first month. Just thought I'd throw it in there.
Thank you. Appreciate that.
Oh, there you go, right there.
There we go. Yeah, put it up there at the last minute. And this is the platform we're talking about, folks. This is Market Gear. What I want to do, just from a time standpoint, we're not here to do a demo of this. I just want to use some things here to share with you a couple ideas kind of in the current environment. So one of the things that I had talked about here was you want things that are moving, right? You want things that are trending up. And so one of the places that we go to here, we have a scan that is top performers 90-day by percent. So this is, these are all stocks that are based on, are doing well based on their last 90-day performance. And it's a pretty good size list of them here. In fact, if we look at the very first one, by the way, this percent move is in the last 90 days. We have Plug Power here at 300% return in the last 90 days. We only show the top 100. If I go all the way down to the bottom of the list of the top 100, it's still 83% move in the last 90 days. So there are opportunities to find stocks that are doing well. Now, the thing about this, I will tell you, when we do look at these, one of the things that we want to see is we want to see that driving force, right? So just because the stock's trending higher doesn't mean it's going to keep going. So why do I think it's going to go higher? For time's sake today, let me just tell you that we're looking at not only what's happening with technicals, we're looking at what's happening with institutions and insiders, and we're also looking at where it's at with its fundamentals, and making sure that there's a reason for this to be going on. It's not overvalued, things like that. So we're doing a broad spectrum. Why? Because we're going to be in this trade. Usually we're going out about 90 days in the position. Why? Because I want time for it to move, right? In your put spread, you actually want to stay in that as short as possible, right?
Yeah.
Now, I know when I do put spreads, a lot of times I'm looking for the 2 weeks to a month, maybe.
Actually,
sometimes
for me, I even go a little shorter. The way that I look at it is, it's like, if we're in a trend, I want to make sure that trend is going to continue on, but I don't want to give it enough time for it to change its mind.
Yes,
so generally,
right.
I go for like a 7-day, like that. The closest to 7 days out is usually my go-to.
Well, I'm going to tell you that, and by the way, that's an absolute, 100% absolute valid way to do it. And especially because you're trying to get a little bit higher return. When we talk about put spreads, I'm going to talk about 10 to 20% is kind of what I'm doing, but I wanted under a level of support. So I'm going to be further out of the money probably than you are, because I want a support level to be on this as well. Now we're shifting strategies. I don't want to do. I'm going to stay back on this. What I'm going to do here is I want to make sure that it's not only trending, but that it can continue that trend. So we have ways of finding that within the platform. We actually have specific trade finder strategies where I can actually go in and look at
cool.
bull call spreads that are we find in here. Now I want to do it more the manual way, because I don't want to, I want to give people information they can use. So there's 34 criteria that go into finding our bull call spreads when we, in our trade finder stuff. The average person is not going to go through that. We want to talk about what somebody can do. So what am I looking for? Number one, I'm looking for stocks that are trending. Number two, I want to make sure they're not overvalued. They're either fair valued or undervalued, that they have strong trend in their, I'm going 90 days out. So I want to make sure they've got some fundamentals to support this as well. Where if I'm just riding a short-term trend, I may not care about that as much. If I'm 2 weeks in it or less, may not care as much. But if I'm going out further, I want to make sure that it has, reason to keep going up and nothing, no red flags. So, indicating that it's going to shift on me. Right. So that said, I have a couple here that I want to talk about today. This is our research part of the platform where you can get an overview of the stock, and then you can go into detailed charting and options and all that. And so what I want to do here for this is there are a couple of them I want to look at. One, I'm going to look at CRISPR Therapeutics for just a second. And so if you look at this here on CRISPR Therapeutics, this has got a strong trend going. It is, if I were to look at the fundamentals on this, this is one thing about this. You got to watch a little bit because, this is a bio, so it's probably not going to make a lot of money there, but they've had good sales trend, good growth in some other areas. We're watching, keeping an eye on some of the things on this. We also have earnings, earnings is out almost a month from now. It's February 10th. So I may not be in it that long. I'm still going to go out longer in the trade. But what I did was I set up, I went and looked for one here for kind of a speed sake here. I'm looking at the 200, 230. Now, when we stage a trade, you can see here on the chart what the two strikes are.
Wow, that's cool.
Yep. So if you look at this, the dots that you see here, that's an indication of staged. If I place the trade, those dots are going to turn into dashes, and as soon as that trade fills, those dashes will turn into solid lines, and it'll be on the chart. Whenever you come to the chart, you can see your positions.
That's really cool.
It's really, I'll tell you, for trade manage, it's really helpful. But the green line indicates it's a buy. The red line indicates it's a sell. You can see here it's a $200 call versus the 230 call. So
and let me just rant real quick. I just want to be clear. The staged means we haven't placed the order yet. It's something we're looking at for the future. So we're keeping this, ready to go. We've seen the trade, we've spotted it, and we might want to come back to it. We don't want to forget what it was. So that's what staged means.
Right. So right here, this is in my my staged environment, and that's where. So for time's sake here, I was looking for some opportunities before we got on today. So now, if I go take a look at this, as soon as I click on this, it'll take it over for me to now analyze this a little bit, and let me explain what we're seeing on this page here. First of all, we have the standard option chain. We can go into that too. But we also do the strategy templates. We have 20 some strategy templates, and it makes it a lot simpler to work with, where you only see the strike shaft. So you notice I'm 90 days out, 91 days out. I'm in the 200, 230. Again, my low strike is just slightly in the money, right? The stock's at 202. And now what we're looking to see what we can do here is what can we get? Now I'm going to try to get between that bid-ask spread a little bit. And I don't know if you talk about this too much with your
Go for
listeners.
I'm open.
Yeah, here's the thing about the bid-ask spread. We're both buying and selling an option here. If we look at this, this has $2.90 between the two of them. There's a $2.90 bid-ask spread. Because you're placing a trade that is already hedged, you're both buying and selling, right? We're putting on a hedge. Well, guess what? The other side taking it, the market maker, is also immediately hedged in his position. And so you can get, when you're doing spreads, you can get between the bid-ask spread better than you can if you're doing individual options. And generally speaking, about a quarter between the bid-ask spread. So since I go from the natural to the midpoint, that's halfway across this line. That's about a quarter, right? So
that's a cool little feature right there, actually. That little slider bar.
Little slider.
I've never seen that before, but I get where you're going with that.
Right. So, you're never going to get past the midpoint. So we stop there. And, but so about a quarter, which is about halfway across on this. So I'm looking at getting into, in this particular instance, would be looking at getting into this trade. Now, mind you, this is a $30 spread. So what's the most I can take out of the trade? $30, right? So, so in other words, if it went higher than 230, what's going to happen? And this is actually good to cover because the exit of the trade, you can close out the position by selling what you bought, buy back what you sold, and profit. That's what we did in the trade I was showing you earlier with Netflix. In the case, so if I continue to write it out, what will happen is you will buy the stock at $230, and you will sell the stock at, I'm sorry, I said that wrong. You will buy the stock at $200. You will sell the stock at $230. So you would take in $30 on expiration day if the stock is anywhere above $230. In this particular instance, we're talking about putting $12 in the trade to make 30. That actually works out to a 140% return potential in the trade. So by the way, I also kind of like this where all your calculations are done now.
Yeah, I was just looking at that. That's cool.
Yeah, see a risk reward ratio, also represented in percentile. And it tells you where your break-even point is. My break-even point is at 212.44. It's at, which is basically a $10 move, a little less than $10 move. It shows you what your max reward, max risk numbers are and all that. So, so my max reward in this case is $1,756, and I'm risking $1,200 to potentially make that money. So then one of the things we do, we talked about the bull call spread. I showed this to you. Here's what we do in the platform. We flip that on its side. And the reason is that, I'm not sure, this has been how it's been looked at for eons. What we do is we flip it on the side so that it matches the chart axis, right? So now my profit.
Wait. Show me that again.
Yeah. So here's your standard, right? Here's your standard.
Yeah.
Bull call spread, where I have my dollar price of the stock compared to my profit or loss in the position. What we're going to do, instead of having the price of the stock across the bottom, we want to put the price of the stock matched to the chart.
And the chart's over there on the left-hand side. Wow, that's really cool. I love that.
Now, you only see a part of the chart because it's been trending very strong, and we're showing you the position here. And then we actually carry across what we call our performance channels. And what happens is you look at where the stock's at today. If the stock goes into this dark green zone, you're making money. If it goes above this, the point right here, which by the way is 230, that's an upper strike, you're still profitable. So it shows a light green, but you're not making more money. You're already at your max gain. But you can see here really easily where that is. And by the way, same thing on the downside. If it were to go down, you have some risk in the trade. And then if it goes below 200, you're not losing any more. So it shows a light red indicating you're at max risk. You're not losing more in the trade.
Wow.
And then what we do on the chart over here is we carry this zone, these channels, back on the chart based on the number of days in the trade. 91 days, this is 91 days back on the chart. Now, we know that past performance is not always indicative of future results, but we all look at it, so we give it to you as a reference, right?
That is really interesting. Okay, so this is a 90-day forward options trade, but
Right.
you're giving me a 90-day look back to say, hey, does this even make sense?
Yep.
Well,
Yeah,
and
I
if it
love
was,
that.
if there
That's
was more,
cool.
if there was more of the chart showing right now, then you would realize that we're only shading the 90 days back. There's still the rest of the chart there. It's just below because the stock's been moving up.
Gotcha.
Right. So if it was able to in the last few days get through this much space, what's it going to take to get through this much space? Right?
Mhm.
Is 90 days a realistic timeline to have that happen? I think the answer is yeah. Right.
Yeah.
So it gives you that reference point to it. It's pretty handy to be able to see it that way. And so that's how we're showing it here. So then, by the way, over here on the right-hand side, you get a snapshot of the trade and how it works and all that. So you have a little reference point to it. And then you can also do back testing and look at things and to make sure you're comfortable with the strategy and that. So it's pretty handy. But anyway, so I have that trade there ready to go. It's, I'm seeing it. It's, I think I'm realistic that it could move up that much in 90 days. And if I like that, we just go ahead and we'll go ahead and place that trade real quick. Comes up, loads the trade ticket, already puts my price in that I have. We'll hit that review, and I'm going to go ahead and place this. I'm going to be really clear here. I'm placing this in a virtual account. I do not want this to be considered as a recommendation. And so we have that in there. So now we have that CRISPR trade on. So that's one example of it. Again, we're just looking to see that trade, that potential. Actually, let me just do my stage because I have something just to clean this up now that we can show that a little bit. And there we go. So now you can see here my stage trade I had CRISPR has used. It's used. Now you notice on my chart here, these went from dots to dashes because now this is a live working order. And when it fills, those will turn into solid lines. So that's one that just show you that. And then we had one other one I just want to show you real quick is we had Roku was another one that we were looking at. And in Roku, let's just show you this real quick. Again, look at the trend on this. This is a 1-year chart, but if you look at the trend, let's take it back to 6 months because we don't need to look back. See what's been, Roku, and by the way, same thing. Right now, Roku's kind of slowed here a little bit on this, but again, some driving forces behind it, some good earnings that just came out on it. We like what's going on with that. So we also look to see what we could do on this one. And again, if I go and do my analysis on it real quick here on Roku, whoops, that was the play button. That was the actual to do it. Go back to stage to do the research on it. Roku, boom. And then again, you have that same thing here where I'm 91 days out, did the same expiration April 16th because I like to be about 90. Here's my rule of thumb for this. I look at what the trend is, how long I think it's going to take to move that trend, and then I double it because trends don't always keep going. Right. So they might hiccup for a little bit, pull back just a little bit. So if I give myself twice as much time, two things happen. Number one, I have more time to be right. Number two, if it does break its trend and I want to adjust and repair, make a shift to the trade, having more time in the trade gives me a lot more flexibility in how I would adjust that trade. So, it's again, there's just because you start in a bull call spread doesn't mean you have to end up in a bull call spread. You basically, when you get into the trade, now you've just got inventory, and I can shift inventory around to shift what the outcome of the trade is. So again, a pretty cool thing to be able to do here. Now, notice something on this one. We're talking about this trade. If I look at the 410, now the stocks in this case is just slightly out. Stock is at 409.65. The 410 option is $52 to April is $52. It's more than 10% of the price of the stock. Now, so if I were to go buy that, I got to have it move to double in money. It's got to move up, like $100.
Yeah.
So what's the odds of that? Compared to the odds of it moving up. Oh, I don't know. Let's see. My break even on this, or my max reward on this is at 430. I'm at 409. So if it moves up $20 and actually 35 cents, $20.35, I'm able to double in money in the trade, more than double in money in the trade, 120%, 119% return. So where if I just bought the option, it now has to move that, all the way up there, nearly $100 to double in money. But here's the other thing about this, and it's one of the things I love about spreads versus directional options trading. Why is this option $52.95? Because the market thinks it could move that much. You follow that, Chris?
Yeah.
Right? That's why is there so much premium in there? You're not going to find a $52 premium on GE because there's no chance GE is going to move that much. But Roku, because the options market feels like there's a chance for it to move that much, it's priced accordingly. And that's the volatility factor, right? The IV anticipating that kind of move. And so by putting on the spread, all I'm doing is I'm playing this little tiny section, 410 to 430, while the market is priced for this to go up to literally 460. Now, does that mean I cap out at 430? Yeah, if I don't get out of the trade, right? But if it goes up, I could certainly take money off the table and go back in at a higher strikes. I might go back in at the 430, 450 or something like that, at a higher strikes. So the fact that these options are so expensive actually to me says there's increased possibility of it moving that much. Right. Otherwise, it wouldn't be that expensive. And so by putting in only $9.35, actually in this one, we're going to work that spread again. Same thing. We'll get in here for maybe about $8.75 instead of $9.30, a little bit improved rate. That's, by the way, that little difference. This is just to show your listeners, viewers here. If I take this at the natural, I'm at 115% gain potential.
Wow.
If I work that bid-ask spread to get between that, it jumps from 115 to, in this case, literally 129%.
Just on the bid-ask spread. So that's really wide to me. Like that would cause concern because then I'd be worried about liquidity.
Well, so now look at this though. I'm only talking about you're talking about $1.05 on a $50 option.
Yeah.
Right. If you were talking about, this is, so if you look at this one, it's $2.25 between this, which seems like a lot. But if you look at the actual option itself, you're talking about $1.05 on a $50 call option. So now, let me be really clear though. Yeah, liquidity is a factor and it's something you want to be aware of. It was already something I looked at before we got into this. There was one I was looking at earlier that the bid-ask spread was so huge. It wasn't even something I'd consider. So it's something that you want to look at. What's the bid-ask spread relevant to the individual options? You're going to put on a spread. So you're going to increase your bid-ask spread because you're doing two, but you're also, it's not $2 on 9. It's $1.05 on 50. And if that's reasonable, then when you get into this, you're okay. But it's also very important you get between that spread, right? That's another reason why it is very important that happens.
Yeah, that makes sense.
Yep. So then we have this the trade here where again now I'm in at 875. I have the potential to make in this particular trade. It's the spread minus the cost of trade. So if I'm looking at this as a $20 spread, I have 875 in the trade. So I could make 11 and a quarter in the trade. That's 129% return potential in the trade. Now there is one thing I want to be clear on this though, because there is this thing of, well, if it goes up there tomorrow, do I make that full amount? And the answer is no. And let me just, I know, right? But let me just show you something real quick. So this is that I'm showing it to you in the regular way now, not on its side. So what's going to happen is as the stock goes up, it's true that at expiration, you're at your full gain as soon as it crosses that upper strike of 430. In the meantime, there's going to be a little bit of a curve to this.
Mhm.
And so one of the things that I like, if we were talking about the trade, the other one we were doing here, where I was talking about the trade on uh, uh, this one here. Here we
Was it
go.
Netflix?
Yeah, Netflix. Yeah, just one. So at Netflix, even though I was out to September on the position, by the time it was, and mind you, I had the ability to make over 100% return on it. I was only, 25 days. I was only at 85% return. Right? Only, right? But here's what happens. Once you start to get up above that, you can see this kind of levels off a little bit. When you start to get a diminished return, what I do is I'll take the trade off and then I'll put it on. If I still like the trend, I'll put it on again at higher strikes, because what I want to do is I want to ride that sweet spot in the trade. And that, so I just want to be clear that, it's not like you're going to make the whole amount right as soon as it's 430. It's at 430 at expiration, but you are still going to make money as that starts to move up. So, so then again, if I like this trade, I just hit my trade button. It's going to fill out the trade ticket. It's going to carry across the work of that price I was working, and we'll go ahead and place that trade as well. And then we've got that one going on as well. And if I go over to my if I go over to my chart, you will see again that trade is there and been placed to now. Now it's that dashed line, and we're waiting to see if it fills. Right. So
yeah, that makes sense.
So that's a little bit about the bull put spread. You do want to have a couple of checklist items here. Number one, because you're doing it where it's going to, you're basically buying your lower strike at or just slightly in the money. You're selling a strike further out. Now I did $30 strike here. One of the things I want to share with you is that if you're doing a $400 stock and you do $5, if I did the 400, 405, or the
Sure.
let's say 410,
I think that's a fair start for somebody.
Right. The only thing about that is because, all right, so I'm going to get a little advanced for just 1 second here for your listeners, but it's something that's really kind of important to know about the way these work. So I can't actually do $5. It's not available. I can do a $10. And what happens is the closer these strikes are, the delta difference between the two is not that much. So if I look at this right now, what is delta? Delta is the rate of change of the stock compared to the option, or the option compared to the stock. So the way this is working right now, if I do too tight of a spread, the stock goes up $1. I make 56 cents on the 410, but I lose 53 cents on the 420. So I only make 3 cents in the trade. Mm-hmm. If I widen my spread out, now it starts to make more money in the trade. Now it's also going to peak out when it gets in the middle of that. That's going to go up too. But the wide, if you get too close together, if I have a $2 bid ask spread and I'm only making a nickel per dollar move of the stock, it's going to have to move a lot for me to make up the difference. So
I had heard somebody call that delta scrubbing.
Delta scrub.
My friend Dr. Jim Schultz from Tasty Trade, I had heard him, this is years ago, call it delta scrubbing. And it makes sense because you got deltas working both directions since you're long and short the position. So yeah.
So you're making the net delta of it, which by the way, we show down here in the bottom, we show you what the net delta is in our analytics, but you can also expand and see it here, as well. So so you can see what that is on it. By the way, look at my time decay. Look at my time decay. My time decay is virtually nothing right now.
Yeah.
Because if I bought the option, I'm going to lose 41 cents a day. And the other one I'm making right now, 40, it's saying 42, but it's kind of just scrubbing out to zero. So that shows you though, that difference, right? Where I'm buying and selling time, I've reduced the impact of time in the trade. In fact,
I was going to say, wouldn't you want that to be a positive value? Then I was thinking, well, not necessarily, because then you just eliminate that variable. And I'm all about eliminating variables.
Yeah. I want this to be, I'm playing the trend. I'm not playing theta. Now, if you're doing the bull put out of the money, you're paying theta. You want that to happen because that's how you're making the money. In this case, I'm playing the trend. So as much as I can neutralize that, the better. And by the way, you'll find that if I were to go out so I went out 90 days. If I looked at 60 days, let's just, here you go. If you look at this, let's take this back down to, here's 35 days. 35 days, this trade is, the natural on this is $14.90 for 35 days. I'm going to go out now 90 days, and I've gone from $14 and change to $15 and change, right?
Right.
So I've got 3 times the amount of time, nearly 3 times the amount of time for a minuscule amount more money. Why? Because I'm both buying and selling time. So it's a lot easier to give yourself time to rewrite when you're doing a spread than if you're just buying out directional options.
I see what you're saying.
Right. So that minimal cost difference for going out further in time just gives you more time to rewrite and more time to adjust if something does go wrong. So that's a little bit on the bull call spread.
Just a little bit.
Way. I know we went into a little bit.
We covered a lot on that, Rance. What are you talking about?
We did. But I think it's a great way to kind of introduce your people to doing a little bit of that compare of it, and just look, take a look at it. One of the great things, by the way, about the platform is that, and again, we'll share that site with you in just a second and what the setup is. But one of the cool things about this is that when I choose a strategy, if you're fairly new to to the combination strategy spreads, one of the cool things about this is you can't break the trade. It's going to be a bull call spread. I can't it won't even let me choose a strike lower here where it would no longer be a bull call spread. It won't let me use different dates because that wouldn't be a bull call spread. So it keeps the guardrails up there to make sure that you're in what you think you're going to be in. And while that's great for beginning people, it's also, as you're more experienced, it just makes it that much easier to do. And the little thing I showed, I did it here. I'll just show you this real quick. You see the position here. If I say this isn't the ideal, I can move this up or down. You see what's happening over here. Don't look at my cursor. Look at the P&L graph in the chart. You see I can move this trade around to find an optimal.
I see. Okay.
Yep. And what's happening when I do that, once I've established the trade,
turn the risk graph. Turn the risk graph.
Let me turn the risk graph. That's yep. So as I do this, then I get to see where I'm at on this. So by the way, if you're talking about doing it in your method, right where I'm below the current stock price. So now, as long as the stock doesn't go below 373 and it's at 409, I'm going to make the total gain on this, but it's only 68%.
Right. Different profile there, but yeah.
Yep. But it's kind of cool to be able to you look at the chart, you look at this, and you can move this around and help kind of optimize your spot.
Yeah.
Where you want to do it. So anyway, so what we had here was
that's just a tiny bit on bull call spreads.
Yeah. Right. I mean, we didn't even get into all the adjustments we can do and the other things about this, right? So
I actually, you were saying you had 11 different ways to do it. I would love to cover that in another episode. I think that would be highly, highly useful.
Yeah, I'll tell you, there are 5 primary that I'd like to cover, because 11 you'll start to start confused. But 5 primary adjustments. I'd love to do that with you. It's a very cool thing to do.
Yeah, let's do that. Because I will tell you, one of my most SEO friendly videos that I have is how to adjust a put credit spread. So if I could have the bull call spread too, that'd be great.
I'd be glad to do it for you. It's you can be really nimble with it. So it's
cool. Yeah, I'm looking forward to that.
Yep. It's harder. I'll tell you what. It's actually harder to adjust the put credit spread. There's there's limits on what you can do. Still, there's some great adjustments. I'm glad you guys do it, because a lot of times people they freeze up. It's like it's not going right, so they freeze up, and then they end up losing money they didn't have to. In the bull call spread, there's even more flexibility. So I'd love to share that with you.
Yeah, let's do that.
Yep.
But before we head out, let's make sure that everyone who's listening at this point probably already has, but if you haven't already, marketgear.com/Chris Uhl, that's CHRISUHL, that's me, to get your 2-week free trial to Market Gear, where you can actually work inside this platform that Rance is showing here today, and you'll get 50% off your first month after that trial's over. So that's a really, really sweet deal to get you started over at marketgear.com. Chris and Rance, hey, thank you so much for going through all that today. I feel like we opened the floodgates on bull call spreads. So thank you so much for covering all that.
Not a problem at all. Glad to be able to be here and share it with you.
Yeah, and thank you guys for tuning in to today's How to Trade Stocks Options podcast. Make sure you like, subscribe, and enable notifications. That way you never miss any of the tools, tips, and tricks we upload every single week to help you trade faster and trade smarter. And I'll see you on the next episode. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.